And then another one real quick here. Amazon is looking to buy MGM Studios, the golden, I-type franchises, James Bond, those type of movies, the Pink Panther. MGM is a famous Hollywood studio from way back in the day. Got a lot of content catalog. Looks like the deal will be between 7 and 10 billion, somewhere in there, and add to their Amazon Prime suite. So more of these streamers obviously looking to acquire content.
I didn't really care about that news, Tim,
Mm-hmm.
but it made me interested in looking at an article.
Okay.
And I pulled up the article, and it was talking about, there was an analysis, there was an analyst on Wall Street, I can't remember who it was, who was making an argument that Amazon has better valuation than Walmart, and that Amazon, based on the fundamental metrics, if it simply catches up to Walmart's valuation, would have 45% appreciation in front of it. And I believe their price target on Amazon based on the fundamental metrics was in the 4,400 to 4,500 range, right?
Mm-hmm.
And my first instinct was, okay, who decided to wake and bake? Like, we need to have a conversation on this.
Right.
Like, what are we doing? Like, this doesn't make any sense. Like, Walmart, Amazon, like, doesn't make any sense, right? So I decided to go dive in a little bit. And I'm not going to lie. I kind of had a moment where I'm like, I could see it.
Was he making the compelling case? Was it around revenue and future growth and the cloud storage components?
It wasn't.
Kind of stuff?
It was one key metric from a fundamental perspective, and it was the PEG ratio. When you're looking at PE ratios, Amazon historically it's in Tesla territory historically, right? Mm-hmm. Amazon was 400 PE, 600 PE. Over time, it grew as a company, though. And so I decided to go look into it today. And right now, guys, they're rocking at a 62 PE ratio. Amazon is. Okay. As Amazon's neutrality has happened, guys, what also has been happening, you can see it from a technical perspective. Remember what I'd say about the 200-day moving average in long-range neutrality? The fundamentals catch up over time.
Is that a box on Amazon?
Oh, it's a box. It is a box. The fundamentals do catch up over time. And what's happened is as Amazon's revenue has been increasing over the last year, but its price has been stabilizing over that same time period, the PE ratios actually came down because revenue has increased and prices stabilized. And so Amazon actually has a better valuation from a raw metric of PE ratio more now than, quite frankly, at any point in Amazon's history. Literally, any point, at any point. When you look a little bit differently, because PE ratios can be widely misunderstood and they can fluctuate based on a lot of metrics, right? So a lot of investors will look at the PEG ratio, which takes PE and divides it by growth. And so it takes into account growth in the valuation concern. And when you take a look at the PEG ratio, and let's go to FinViz very quickly here. Just give me 1 second so I can kind of show you this. When you look at Amazon, because when we all look at Walmart, we all assume a fundamental darling Walmart, right?
That's right. Yeah, value company. Yeah, absolutely.
138 billion. Just write the zeros and you'll be impressed. Well, when you look at Amazon here, right, AMZN, 62 PE, forward still elevated, but again, better than it has been. That's the argument they made right there. 1.62 on the PEG ratio. Now, anything under 1.5 in this market is pretty decent from a PEG ratio perspective. Well, the argument that they were making, and I disagree with the argument, because what they're saying is Walmart's overvalued and Amazon will become overvalued similar to Walmart. I think the entire premise of the argument is false, but it does pique my interest. But when you look at Walmart here, they're saying from a PEG ratio only, right? The entire analysis was PEG ratio. Mm-hmm. Well, if Amazon simply does from a growth perspective, and gets to where Walmart is from a PEG, they have that 45% above expectation. Well, Walmart also has a PE ratio of 29, forward PE ratio of 23. That's elevated for Walmart historically, by the way. That's fairly overvalued for Walmart historically. But again, when you take into account price to book, 4.85 on Walmart, Amazon, you have a price to book of 15.95. So I felt like they were picking what analysis fit what they were trying to do, but it did spark my personal interest in looking at Amazon's fundamentals. And Amazon is in a better fundamental condition right now against Walmart than it has historically. And it's because Walmart's fundamentals have elevated and Amazon's has contracted. And I think that should pique the interest of people that have not been a part of Amazon historically. And I think that interest, that opportunity happens on a breakout in Amazon. But I do believe an opportunity has started for a lot of people that historically did not get a play out on Amazon when it went from 1,500 to 3,300 in the pandemic, or when you're thinking about Amazon over the last 20 years and how many different amazing, impressive runs did Amazon have. Well, in all of these run-ups here, 600 PE ratio, 800 PE ratio, 900 PE ratio, 500 PE ratio, 400, 300, 200, 100, wide range neutrality over the last 8-9 months, 62 PE ratio, PEG ratio at about 1.5, price to book still elevated at 15. But the metrics are getting better from a fundamental perspective. And at this point, Amazon historically has never been tighter against Walmart from a fundamental perspective, given that Walmart is a little elevated from a fundamental perspective against its historical backdrop, whereas Amazon has contracted there. I think it's interesting, and I really think it's interesting above 3,500.
I think it's an interesting premise, and I appreciate you sharing some of the data that you found from that article that you were going through from the analyst and whatnot. Couldn't it be that the strong argument for Amazon doesn't have to be an argument against Walmart, though?
No. It's not. Okay, let me be clear. It's not one or the other. I know they compete, but I don't believe they compete from a portfolio perspective.
Sure.
Okay, we're talking about two different companies. We're talking about Amazon, who's tried to become the online Walmart, and now Walmart over the last 5 years, who's trying to become the online Amazon. But again, I don't think they compete from a price perspective, and so no, I don't think it's that simple. And I also don't think good analysis on Amazon means negative analysis on Walmart. Like historically, is that what we see historically?
Mm-hmm.
You know, when we're looking at, say, the last 20 years of data, there's Amazon, there's Walmart. So I don't think it's one or the other, but you use the comparative analysis on it because it allows you to understand Amazon's valuation better, in my opinion, especially in the backdrop of what has transpired with Walmart. And I still believe Amazon, I don't believe this, I know this, Amazon is still more overvalued than Walmart is, but there are a couple of key metrics that are very, very interesting on Amazon, and that is the PEG ratio, that's the contraction of the PE ratio as the revenue streams are now catching up. I mean, Amazon, we geek out on Amazon, on Walmart's 138 billion. What, should we just scoff at the 103 billion that Amazon just cashed in this quarter?
No, we like geeking out about that one too.
We'll geek out on that one too.
Yeah.
But again, I don't think it's one or the other here for me. I do think Walmart's fundamental analysis does help Amazon's understanding of where it is from a historical valuation perspective, though.
Absolutely. Love it. Glad you broke that down. And that PEG ratio stuff really is very interesting to think through, is the way that they're presenting.
Oh, and I know a lot of traders that talk like, can we just talk technicals again? I like fundamentals.
I don't think that's what anyone's saying. I think that was definitely well worth the time to dig into it. Absolutely. Thank you.
It makes me put Amazon. It makes me put Amazon in one of those, like, could it fit in my portfolio now?
Hold on.
It's one of those things that you wouldn't even think about. Like, with the PE ratio, I would have just assumed it was still up in the 200s. If you ask me, I would have never thought.
If you were to ask me, and I have not looked in months, I would have said short of triple digits, but
So
I would have
I would have guessed 80.
I would have guessed 90.
Really,
I would have off top
I
of my
thought
head.
it was a
I
great
haven't looked for
breakdown.
months.
So the queen likes Amazon. Let me add that
Oh,
to my
good
queen's
Lord.
court.
See, this is exactly how you have
Listen,
your head chopped
listen.
off.
The queen is going to love Amazon when it breaks out at 3,500.
Break out of that box. Absolutely.
And not only does that, but the queen loves. Do you know what the queen really, really loves, guys? The queen loves this. Wide range neutrality, 50-day period weekly.
Holding.
And then look at the increase. You are starting that breakout of 35 from 3150 because the 50-day moving average versus 29. Much cleaner breakout potential here. So, Queen, I'm going with Amazon if you love the breakout of 3,500. I'm going with Walmart if you love that analysis. Either one, I'm covered. I'm good.
By the way, and Dennis in the chat here, he's right. Amazon needs a 33-to-1 split. Add a 33-to-1 split in this analysis, and look out.
That's like Mark McGuire taking steroids.
That would be nuts. So everybody would want a piece of Amazon immediately on that in that scenario.
I do think Amazon missed a very unique and special opportunity on a 10-to-1 split.
Yeah, they could have done it on their earnings report. Yeah.
Now, missed means they could do it next quarter or the quarter after that.
And maybe they were just hinting at it to start getting it into consciousness and all that stuff. Sure. I mean, maybe it's coming down the pipeline. I thought they should have split this quarter, though. I mean, it was out there. It was in the lexicon. People were already talking about it.
We all want this company in the Dow. Like everybody in the world wants this company in the Dow. Put the 10-to-1 split. By the time this gets done, you're going to have to do a 20-to-1 split. Let's go.
That's right. Exactly right. Anything else there, Maddie, from you?
Oh, I got lots of things, but I'm good.
Well, I do. I'm interested in your take on Berkshire Hathaway's 13F, if anything.
Berkshire Hathaway, I'm interested in him getting rid of all his banks.
Man, he did. U.S. Bank, GM, AbbVie, Stone, Merck, Chevron, Liberty, Wells Fargo. I mean,
yeah, but all the analysis is value on value type stuff. Like I got rid of Wells Fargo, but I added an insurance company.
And he added some Verizon.
Right. I got rid of this value, but I added this value.
Shuffling the deck is
honestly, though, you are seeing the start of 13F season.
Yeah.
It follows earnings season, and it's certainly not as widely reported. We don't talk about it as much, but maybe one of these Mondays coming up, we can spend some time on the podcast talking about the importance of 13Fs and kind of seeing what these big dog traders do in their 13Fs.
Yeah.